So I think we really are at a crossroads. But importantly, it doesn't mean all of us are going to go down the right path. I think there could very easily be a breaking of the ways here, or a parting of the ways, and some of us are going to a good place and some of us are going to a bad place.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When today's guest was last on this program back in May, he predicted we'd see continued momentum geopolitically away from globalization and towards mercantilism and protectionism. That's proven to be the case worldwide, and particularly so for the US, where Donald Trump has just regained the presidency with a clear mandate to pursue an America First agenda. How is this wave of nationalism around the world likely to impact the global economy? What are its biggest opportunities that it may open for investors, and what are its biggest risks? To discuss, we're fortunate to be able to spend the next hour with Michael Every, Global Strategist at Rabobank, who joins us from Thailand. Michael, thanks so much for taking time out of your busy morning to join us.
Oh, it's a great pleasure to be here again.
Oh, Michael, it's always a great pleasure to have you on. I remember very fondly our time together in Florida earlier this year. Anyways, you're even more of a gentleman in person than you are on the screen. Very excited for this discussion with you because it's extremely timely, as I said in the intro, based upon the recent American election. I want to get into all that. You've just issued, I think, a seminal report that I'm going to say everybody watching here, if you have time after this interview to go read, they should. But before we dig into the details of the report, let's just kick this off with a question I like to start these conversations with. What's your current assessment of the global economy and financial markets?
I'm going to give a literary answer, if I may. It was the best of times, it was the worst of times. And that quote obviously continues, we were all going straight to heaven, we were all going straight the other way. Mm-hmm. It really depends how you want to see it. There are an excess number of really, really worrying structural and cyclical points that you can look at. And there are a growing list of really, really positive structural and cyclical points, depending on how you see the world. So I think we really are at a crossroads. But importantly, it doesn't mean all of us are going to go down the right path. I think there could very easily be a breaking of the ways here, or a parting of the ways, and some of us are going to a good place and some of us are going to a bad place.
So when you say some of us, do you mean this geographically? Like some countries are going to do well, other countries aren't going to do so well? Or do you see this more societally? Like, hey, the top 10% is going to be fine, but a lot of other people aren't.
I think one is joined at the hip to the other. It was in the past global structure, and it will be again in the emerging new global structure. So it's geography and it's demography, if you will, or societal.
Okay. All right. Well, that's an onion I plan to peel pretty extensively in this discussion here with you. But if we can, let me raise this new report that you wrote, and in the context of doing so, let's return to our previous conversations we've had when you've been on this channel, where you have been vocal, not just recently, but for years, that the world order is shifting. And it's shifting away from globalism. And look, you've been saying this for years, even as globalism was as we were continuing to get to peak globalism and nobody thought that train was going to stop. You've said, no, look, we're going to go much more back to a multipolar, nationalistic, mercantilistic way where it's more sort of every country prioritizing its own issues, and it might not be a free-for-all, every country for themselves, but it may very well fracture into different blocks, and it's going to be me and my team versus that team or those teams. You're nodding as I'm saying all this. Can you just, one, confirm that that's the case, and maybe just give a little bit of a background of your framework before we get to the insights in your latest report?
Happy to confirm that is indeed what I was seeing, what I am seeing, and what I think we will continue to see. And just as a very, very quick background, the reason for that was simple, that the entire global system that we've lived in for decades emerged, first of all, post-World War II, as we know, and then very much post-Cold War, after the Soviet Union had been defeated and collapsed. And we effectively had, for the first time in world history, a complete global system where everyone was linked in with the dollar network. And it looked like it was going to be the best of times for everybody. That's what we were promised. But even though it's been very, very economically successful in the aggregate, which is undeniable, there have been very, very clear winners, and we all know who those are, both geographically and within society. And there have been very, very clear losers. And while you could make a successful argument for a long time saying, well, the losers, aren't powerful enough to change the system, so therefore it will just stay forever with the rough edges. That's just the way it is. My argument was always that no, okay, fair enough. We don't have to expect there to be a revolution where you're going to have all the working class of the world uniting. That's very unlikely to happen. But what will happen instead is America will realize that this system, which it set up at gunpoint because it felt it would keep the world safe and keep America prosperous within that world system, is no longer safe and no longer as prosperous as it should be equally within that system. And that impetus will lead politicians to emerge who will demand that it is changed to make the world safer and more prosperous for America as a whole. And I think that pretty much captures the zeitgeist that we saw in the recent US election.
All right. Well, so let's dig right into it then. We just had this election. Trump, as I said, rode in on a wave of America first, make America great again, obviously. Number one issue cited by voters was the economy, basically make the economy start working for us again. You just put out a tweet that says Trumpism equals mercantilism and US nationalism. This combination is uncommon, especially for big powers. Trump goes back to the founders' foreign policy that abhorred, quote, foreign entanglements, which means you need to study economic statecraft, not economic policy. So help us understand that better. What's the difference between statecraft and policy, and why is statecraft now becoming more important than policy? I was actually going to say, why does it trump policy? But I felt that that was too cute of a pun.
I did make that pun myself, actually, in
Oh,
an
there you
earlier
go.
one, so I can see why you nearly went for it. Okay, first of all, that tweet, by the way, a lot of it is me quoting a report from Branko Milanovic, who was an intellectual that I think everyone should read, and he was basically refuting what you see as a popular talking point, that Trumpism is fascism. Very controversial. I have to say I don't agree, and he doesn't either. And he's a man of the left, a very deep, thoughtful man of the left, who is no fan of Trumpism per se, but he's saying you can't just use these very shorthand arguments and dismiss all the underlying trends. And he said, if you look at the economic argument, no, it is indeed economic nationalism slash mercantilism. I've made that argument before, as you said. And specifically, what I think you need to keep in mind is what I bring up in this report, which I've recently put out. And the title of it was Macro Strategy versus Grand Macro Strategy. And I'll unpack that just for a moment, if I may. It talks about the fact.
And sorry, actually, I started to interrupt. Before you go on to that,
Yeah.
just for folks that don't perhaps know exactly what you mean when you say mercantilism, since it's so important to what's going on, can you just define that real quickly?
Absolutely. And I hope, and this is no reflection on yourself or viewers, next time everyone will know what the word means, because it's a good word to know. So mercantilism is a very old economic theory. It's hundreds of years old, and it emerged in Europe, at least by that name. And it emerged at a time when the currency was largely silver. We like to say gold. It wasn't. It was actually silver most of the time in that particular era. And physical metal was physical currency. So talk about a hard currency, and talk about a rigid monetary system. So if you run a trade deficit in that environment, what happens to your money supply?
Your silver is getting sucked into some other country's treasury.
Exactly. You literally don't have money. So your economy deflates. If your economy deflates, obviously you're getting poorer. People can't pay their bills. Everything starts to collapse. There's no Fed who can step in with emergency liquidity because it's only physical coinage that you've got. The other country sits on all the treasure. They can afford to buy mercenaries or hire mercenaries. They can afford to arm themselves to the teeth. And they can literally steamroller you. They can either do it economically or they can do it physically and politically. And they did in Europe over and over and over again for hundreds and hundreds and hundreds of years. So mercantilism was basically a trade policy where you said we want to try and retain as much money as we can. So we want to export as much as we can and as high value as we can, and import as little as we can and run a healthy trade surplus. And once you move over to paper money, which of course we now have, fiat money, and you've got a Fed or a central bank in the background that can provide emergency liquidity, you don't need that so much. And certainly, even in the old days, if everybody did mercantilism, well, it didn't end well because you can't all run a trade surplus. So, of course, it ends up being quite violent. But the problem is, under a paper money standard that we have today, yes, you can paper over the cracks, if you will, by just giving liquidity to everybody, but it doesn't flow to everybody. And while one country runs a large trade surplus, e.g. China, Germany, etc., and others run a large deficit, particularly America, that's the key point, you do lose jobs, you do lose manufacturing, you do lose technology, and you do lose geostrategic power, which is absolutely the case. Yes, you have a large consumer base, but you're not making anything. And when you have a national security crisis, i.e. something like the COVID pandemic, or when you have a war, you suddenly find we can't make X and we need it in large numbers now. And without it, we're in real trouble. And that will keep happening again and again. And the only defensive pushback against that is to say, we are going to try and remove as much as possible the trade deficit with other countries, which is a product of them running mercantilist policies. Because if a country wasn't running a mercantilist policy with you, with America or anyone else, unless they're an exception like Saudi Arabia or the UAE, where you have a relatively small population, a hugely valuable commodity, which you're always going to sell more of than you use domestically, you should run balanced trade. If you believe in free trade theory, as we are taught it in economic textbooks, everyone, pretty much everyone, should be running balanced trade all the time. The composition of the trade basket would change. What you import and export would shift, but trade should clear. That does not happen. That will not happen in a vacuum. And as a result, America, and I've been arguing this, as you said, for years and years and years. 2016 was when I first put out a big report arguing this. We'll move back to mercantilism in response to others' mercantilism. They will mirror it back at them. And that's exactly what we just saw in the last election.
Got it. And it will look like nationalism, it'll look like protectionism. These will be the labels put on the policies that we adopt in a more mercantilist era, correct?
Correct. And if you don't do it, to be really blunt, and I'm jumping kind of to the end point of the whole discussion, then you just get a continuation of what you see now, which is obviously further offshoring, so further loss of productive capabilities in key areas, which even the Biden White House was trying to push back against with the CHIPS Act, Science Act, the IRA, etc. Whether you agree or disagree with them, that's what they were trying to do. And you must, let's be very clear on this, as a logical and unavoidable corollary to running a large trade deficit, you must increase your debt. Because if you don't increase your debt, you increase unemployment instead. Either money just floods out of the country and you don't increase your money supply, and that's it, everyone loses their job. Or you pump money into the economy via debt, which is recycled back in from the dollar earnings of the countries that have sold to you, and you go further in debt to them. So is that sustainable? No. Everyone who's talking about the American debt picture is worrying. You're a mercantilist. You must be. You might think you're a free trader, but you can't be a free trader if you want to deal with America's debt picture. You can only deal with that by dealing with the structural trade issues. So you are already in my, not you, Adam, but if you're listening and you're thinking, yeah, I want to bring the debt down, you're on my team already.
Okay. So to you, this has been an inevitability. You've been preaching that for almost a decade now, and the world has took them a while, finally beginning to wake up to say, hey, that Michael Every, that guy's onto something. So you just issued this report. Again, the title is, was it macro strategy versus grand macro strategy? You'll explain the difference. But as you explain it, again, please explain your definition of statecraft and why is statecraft becoming more important than policy at this stage?
Sure. Okay. So let's go back to where we were. So statecraft and policy are very different. Economic policy, we all understand. You're trying to, for example, get CPI back to 2%. You're trying to keep unemployment in a reasonable range. You're trying to keep the budget deficit at 3% of GDP, like in Europe. That's something they aim for. So we understand what the target is, and it's a domestic economic variable with which you use your policy toolkit. And that can be trade policy, that can be capital policy, that can be monetary, that can be fiscal. It's primarily monetary and fiscal we use, or it can be supply side in various different forms. Okay, so no need to discuss that. And that's what most people spend most of their time discussing. That's economic policy. Economic statecraft is a far older way of looking at the world, which predates mercantilism. It goes all the way back to the ancient Greeks. It goes all the way back to Sun Tzu in China, thousands of years ago. It's very, very ancient, which is understanding if you want to run your country successfully in the long run, the economy is an instrument of power. It's an ability to maintain domestic stability or lose it, and to project international power or to face international weakness. So economic statecraft effectively recognizes that economic power sits alongside military power and political power as three legs of a stool with which you try and achieve your country's national interests, which is defined as something called grand strategy. Now, let me give you an example. The British, you can probably hear from my accent, and I hope everyone can understand, I'm speaking as slowly and clearly as I can with my Pommy accent, that we had a grand strategy for a very long period of time. We had one. And it was this. First of all, Britannia rules the waves. So we had maritime supremacy through the British Navy. And that meant we had commercial maritime supremacy. We controlled the trading routes for everything that mattered everywhere. That's why the British Empire was where it was located. Secondly, we extracted wealth and military manpower from India for hundreds of years. That made us very rich, India much poorer. And it made our army very powerful because most of our fighting force was actually Indian most of the time, not British soldiers. And then lastly, vis-a-vis Europe, we had splendid isolation, which continues in our national character down to this day, where we said no permanent friends, no permanent allies, and we will do whatever it takes to make sure that you never have a European superpower emerging which can threaten us on mainland Europe. And every time one comes together and starts to coalesce, which is natural in the past in European geography, we will step in and break it up economically, politically, militarily. So you put those three things together, and that made Britain very, very rich for a very, very long period of time. And effectively, America took over the franchise from us after World War II. We just handed you the keys and said, we can't do this anymore. So when you look at the British Empire's decisions in the past, like when did they raise a tariff on this? When did they introduce this particular market reform? What did they do with interest rates? That's economic policy. But the economic statecraft was all of those interactions, which today, in a contemporary form, Bloomberg would be covering as like, a short-term market trend, happened within a broader framework of this is how we are rich if we do this. And everything must be structured around. Economic statecraft is now going to re-emerge in a world which all of us can see as much more threatening, much more geopolitical, to use that shorthand. You can't just use your economic policy toolkit and think that solves your problems. Now, for example, let's go back to the States again. Do you want low inflation? Of course you do. Would you like, around 2% inflation or wherever, people would like inflation to be? Of course. Will that solve your problems vis-a-vis China, vis-a-vis Russia, vis-a-vis Iran, vis-a-vis North Korea, vis-a-vis any number of different threats? Will it solve your trade deficit? Will it solve your government debt problem? No. It's almost entirely irrelevant. Not completely, because there is an overlap with some areas, but you have to use the toolkit totally differently. So what I explain in this report is, once you put on a different set of lenses and you think, what are our national interests? How are we going to achieve them with military power, as little as possible, hopefully, political power, focused, and the economy operating alongside them in a joined up way? Well, then you're going to use trade very, very differently. You might use free trade with some to bring people together, and you might have far less with others. you're going to
Right.
use tariffs. We can see that's
And I
going
was
to
going to
happen.
start to interject, but tariffs is like a classic tool in the mercantilist
Of
toolkit, right?
course. Of course. And you see, if you deal with an economist, and I deal with them all the time, you say tariffs, and immediately their heart starts racing and veins come out on the side of their forehead, and they call it a consumer tax, etc., etc., etc. And God forbid you should ever raise the price of anything. It can't happen. They don't understand what they're used for. They'll say, well, first of all, they'll say at the very least, all they'll do is just redirect trade from A to B. Yeah, that's what they want. That's what they want to do. Don't trade with them because we don't trust them. They're dangerous. Trade with them. We like them. They're not dangerous. That's what they're trying to do. So they misunderstand. They think that's something bad. That's the entire point.
Yeah,
Equally, sorry,
sorry, but let me interject just to make sure I'm grasping what you're saying, because I think I do. But I want to make sure that we're bringing the audience along. Um,
sure.
I think a lot of people, especially academic economists, right, think of the economy as more or less of a self-contained system. It exists in for itself, in and of itself, and the goal is just to maximize economic growth and output. And that's all policy should be in service of. It's just helping the economy grow as big as it can, as sustainably as possible. And I think what you're saying is no, the economy is a cog in a much bigger strategy, and they very well may, make sacrifices in certain parts of the economy to use other parts of the economy to their advantage. They very well may weaponize parts of the economy to gain a larger strategic goal, right? And then when we talked earlier, you talked about how, hey, going forward, don't be surprised if this kind of bailout, blanket bailout practice that we have right now switches from bailing everybody out to no, we're gonna starve this part of the economy to really feed this part of the economy, because that's a better way to achieve our overall national goals going forward. Is that description accurate?
Completely. In fact, thank you
Okay.
for stopping me going off on a rant and coming
No, no,
back to
no,
the.
no. It was great. I just wanted to make sure the audience really gets
Sure.
this, which is the economy isn't just, it doesn't exist in and of it for itself. It is a part of the machine of the ship of state.
Completely. Let me put it like this. In the report, I actually summarize it thus. Don't ask what's GDP, 2.1, 2, 1.9. Of course, that matters, with compound interest and compound growth, etc. But the key question we should be asking, what's GDP for?
Mm-hmm.
And if you can't answer that question, what is GDP for? You're not running any kind of strategy whatsoever. You're just living in a complete vacuum, as you said, just trying to arbitrarily grow a number even larger. I mean, let's imagine a completely ridiculous example, but you can stretch it in any direction you want. Let's just say by some strange twist of fate, everyone in America decided to become a hairdresser. Like the entire economy was just everyone's a hairdresser. All you do is produce scissors, blow dryers, chairs that tilt backwards, mirrors, and shampoo and hedge. Is that an America that's well placed in this world? I mean, everyone could cut each other's hair all day. It's always
Right.
growing. So everyone could be doing that. You'd have to import everything else in the world. But, you could all be happy being hair. No, it's a silly example. But is that what America is for? I don't think so, right? It needs to have more balance than that. So you're already admitting, well, you do need some kind of balance. Fine. What kind of balance? Towards what target? Because let's look at a historical example. If you took current mantra on trade, aside from, the MAGA camp, and even the Democrats shift in that direction under Biden. If you took the pre-Trump, pre-Biden mantra on trade, do you know what America would be producing today if you hadn't had the revolution? Have a guess.
I don't know. I really
Food.
don't.
It'd be a farm.
Yeah.
Comparative
Oh, okay. Yeah,
advantage.
you're right. Yeah, I'm sorry. Yeah, of course. If we were
Why would you have industrialized? The Brits made everything.
right.
We were the engine of the world. We were the workshop of the world, like China is today. You had vast agricultural land, and people would turn around and say to you, well, why do you need machinery? Why do you need anything? You buy it from the British at a high rate, and you export back agricultural products to the UK, and that's the way the system works. That's your place in this comparative advantage. Just be happy, all be farmers. I mean, the world would look very, very different, and
Right.
I don't
America would
think
be
anywhere near
one
as good.
large emerging market in that scenario.
Permanently, yeah. And equally, you can make the argument, and I have, that if you follow that mantra in a world in which everyone else understands what GDP is for, and you don't, you do become a large farm again.
Right.
And if you look at the deindustrialization of America, okay, the tech sector aside, that isn't, a lucky exception to the rule. There was a trend back. If you look at American trade data, they were clear. Up until relatively recently, America was re-emerging as a primary exporter of commodities rather than anything else. So you were going back to being rocks in the ground and farm products. You can do far more than that.
Interesting. So, listening to you talk about this, I feel like, um, probably not until that long ago, the globalist dream, if not, for lack of a better term, was sort of like Star Trek, right? Where you have the Federation, right? And the
Yeah.
world is under one global
Yeah.
unity, right? And we're all just people in the world, right? And I think what you're saying is if that's where we were trying to head, we're going to go much more now towards Game of Thrones.
Star Wars.
Or Star Wars. Okay, Star Wars versus Star Trek.
Yeah.
Yeah, I mean, Game of Thrones, you win the game or you die, basically, right? I mean, it's like, it's all about power, as you said, and it will be countries and trading blocks ever jockeying for power here. When is that analogy? Does that hold any water here?
No, completely. And in fact, if I made the Star Trek versus Star Wars one is again one I made many, many years ago.
Oh, well,
When
there you go.
people,
Okay, great. Smarter mind than I.
you know,
So
no, no,
answer that, but in
I'm more into pop culture, maybe that's all.
no, that's all right. But in your exposition on that, just give us a hint of is this a forever shift or is this cyclical? Like, will we go into Star Wars for a couple decades and then maybe go back to Star Trek, or are we confined to Star Wars going forward?
I love this way of phrasing it. We're in Star Wars now for as far as the eye can see. We hope it's
Okay.
good classic Star Wars rather than really crummy recent Star Wars.
Yeah.
We hope it's,
Yeah. Hopefully it's like the original trilogy.
yeah, it's good Star Wars with the happy ending, right? But it's going to be very hard to get back to Star Trek because let's be clear, the system that we had post World War II, first of all, only existed because of World War II. It couldn't have been set up without that terrible, terrible violence and terrible, terrible destruction. When America set that up post World War II, it was staggeringly ruthless. I was literally having breakfast with my boss this morning talking about this. And I said, if you read the history of that period in detail, during World War II, the Brits and the Americans, we were all allies, with others, fighting side by side alongside each other. And, I'm still very romantic about that period in terms of, the joint sacrifice for a common good. And I believe in that. But the second that the fighting was over, and in fact, even before it was over, and it was clear that America and the West was going to win, they'd already pulled the financial rug out from the Brits. They already said, all that money we lent you during the war, which you can't possibly pay back because your economy is absolutely shattered. And your currency, frankly, is pieces of paper at the moment. It's not exchangeable for any other currency. You only trade within your British Empire bloc because they have no choice.
Right.
We want you to make it convertible straight away. And the Brits went white-faced and said, well, we're ruined if you do that. Yep, well, that's what we want. And equally, at the same time, we are going to insist that you have to bring down your external tariff on the British Empire so that you are now part of a global system, the current global system, and you're on level footing. So everyone's equal, everyone's fair, Americans at the center, and no more empires. So the Americans completely destroyed the Brits as a global power the second the war was over. And in fact, even before it was, to build the foundations for this Star Trek system. So it wasn't done nicely and by consensus. It was done at gunpoint via financial power. But it was done for good reasons. The Americans thought that if they were there in the center and there were no more empires, and apart from the communist bloc, which had to be contained, and that was a different issue, you would have a stable system. Now, you did on the gold standard, and you did before the emergence of the Eurodollar system, and you did when you couldn't move capital internationally, and you did when exchange rates were fixed for like 10 years at a time. So there was no FX trading. You went to the bathroom once in a 10-year period. You missed the one FX move. You had to wait another 10 years for another one. You actually did have stability, but of course it broke down because everyone realized they wanted US dollars, which were pegged to gold. So they all started to export more and more to the US, which was eventually that plus the Vietnam War of spending too much forced the dollar to break from gold. And then we shifted to the same system just backed by the US dollar, and US trade deficits really start to build up very, very largely. Then we still win the Cold War by, Reaganomics, and basically we can spend more than you, we can borrow more than you with low debt. And then the Soviets couldn't, they were an inefficient system. And then we have one world. For the first time in history, we have one world without empires and different zones. And America thought, well, look, if we just copy and paste what we did post World War II, post 1991, everyone's going to look like us. Everything's going to be absolutely wonderful. What can go wrong? Well, within 10 years, of course, you have China joining the WTO on their terms. You have 9/11 and the war on terror. And here we are, not even 25 years after that, this is the happy ending forever scenario. Mm-hmm. And we are back to the long run of Star Wars, which is what it's always been in one form or another.
All right. So a big part of your message then to viewers is we came of age in a halcyon time that really isn't very representative of the long arc of history. And so our sense of normal may be artificial, and the pendulum is swinging back now towards normal. So if we expect the future to look a lot like the past, we're going to be very poorly positioned likely.
Completely agree. And the key part of that I want to stress, and I do in this report, is when you are focused on economic policy levers like interest rates, like fiscal policy, like energy policy, like infrastructure policy, like agri policy, very much capital policy. So, for example, capital control, sanctions, aid, foreign loans, Fed swap lines, and very, very much in terms of trade. And, I think we'll probably talk most about trade here, I would think. You can't just presume you use those tools in the toolkit the way you would do in that Star Trek environment, because it's a dangerous environment where you have to think ahead 5 or 6 steps and play the what if game and think, how can we build a structure that is good for us? Now, will it be completely solo? No, it will still have to be with others. It will still be collaborative and cooperative to a degree. But what can a structure look like? What is GDP for, to try and recreate a world that is as good for America, if we're talking about America, for Europe, if we're talking about Europe, for everyone, if we're talking about them, as possible? And where the biggest changes will have to be is in America and Europe, for sure.
All right. Well, let's talk about those changes. One last thing on the Star Wars versus Star Trek is, as you're talking and thinking about it's the Star Trek universe is like, hey, we've developed warp drive technology. Great. Let's go share it with everybody so that everybody benefits from this great new technology. In the Star Wars world, it's like, we've developed warp drive technology. What can we do to prevent anybody else from getting it so that we will always have a great advantage over them?
Completely. And which one do you think is more realistic?
Yeah, which one fits human nature in the arc of history? It's absolutely Star Wars. Totally get it. So, okay, Michael. So if this is all the context for the era that we're heading into now, what changes do you expect to see? And as we get into the answer, I'd love to hear your thoughts on, and this will be in as nonpartisan a way as we can make it as possible. Do you think the Trump policies / statecraft that he has stated he's going to pursue, are those good or bad moves towards at least the interests of America and, say, Team West?
Okay, let's start with that and then work backwards. I'm not trying to be party political because I'm not American, and I understand how polarized not just America is, but everywhere is. Wherever you live in the world, trust me, you had Team Blue and Team Red, hitting each other over the head with various household implements over the past couple of months, and particularly last week when the election was held. So I'm trying to steer clear of being partisan. But if you're saying which approach is going to work better, is it an idealist one where you presume we live in a positive sum world where the more collaboration we have with everybody, the better it is? Or is it a realist one where you assume actually some things are zero sum. There are winners and losers in trades. And yes, you can work well with some, but others you have to be very, very, very wary of, and some you shouldn't work with at all. Which one captures the current world better? And I think it's realism. Mm-hmm. And I think, the experience of the past 4 years in terms of what happened in foreign policy and the economy speaks to that point. So that's my first beginning. A realist policy works better. And even under Biden, there had been more realism in some areas. Definitely the CHIPS Act, the IRA, he increased tariffs on China, for example. There was not a return to idealism. But what you did have under Biden, and what you still have in Europe, for example, is this rather mixed view of we want to compete vigorously here and collaborate where we can there, and presume that other parties from Russia to China to Iran to whoever understand the difference between the two. Oh, here we play chess politely. Over there, we hit each other on the head with baseball bats. Okay, right. We only hit each other with baseball bats between 2 and 5 on a Wednesday, and the rest of the time we drink tea. The world doesn't work like that. Once you understand that you're going to hit people with baseball bats between 2 and 5 any day of the week, you spend all your time focusing on baseball bats. And so once you start to become realist, you have to become realist. You have to do it in its entirety. That doesn't mean you can't offer a hand, but you have to offer a hand from a position of strength where they have no alternative, rather than presuming that they'll just say, yeah, we prefer that, rather than saying, I've got a bigger baseball bat than you, or, I've now got a flick knife, which is even better, or I've got a gun. Mm-hmm. I'm thinking of the Untouchables now as another cultural touch point, that you have to escalate to de-escalate. So,
don't bring a knife to a gunfight. Yep.
Exactly. So that's the starting base. But if we look at what changes I think we're going to see, I mean, they're already out there in the headlines. We are going to see significant use of tariffs, obviously. And as I was saying much earlier, economists scream and say, well, there'll be big inflation. And yes, if you were to just put up a tariff, let's say 20%, on everything imported into America tomorrow, when you don't produce it, I won't say the price of everything would go up 20%. It wouldn't, because there would be some cost sharing. There would be some invoice padding. The dollar would go up immediately, not down, which would offset some of it. But there would be an inflationary impact if you were to do it like that. But what I strongly believe will happen, and this is based on statements from the Trump camp itself, is that they will have differential tariffs by different geography, which is based on different politics. Are you with us or are you against us?
Right.
And the more you're against us, the higher the tariff. And here's the critical point. They will introduce them T plus X. So, for example, if you say the tariff is next week, yeah, you get all that inflation, or a lot of that inflation now. If you say it's in 2 years, let's say Trump, January comes in and says, right, January 2027, 60% tariff on China, rising to 80 or 100 if they do X, Y, Z. So it's conditional. Companies will rationally invest in America to avoid it.
Right.
But you don't get the tariff.
Yeah, Trump, hearing him talk about this, I mean, I get the sense he doesn't actually ever want to have to impose a tariff. He just wants the threat of the tariff to engineer the outcome that he desires.
Correct. And the outcome is, let's be clear about this, to reduce the US trade deficit. Now, tariffs aren't the only mechanism you can use for that. You can also use the capital account. For example, if you were to change regulation so it's very hard to buy US treasuries, or you were to put a tax on foreigners holding US treasuries, it may not sound logical to many people listening, but that would have the same effect, because when you're country A and you sell a product to America, you earn those dollars, you have to sell them when you get them back in your country. They end up with your central bank, and the central bank doesn't keep them under the bed. They have to put them in an asset. And most of the time, they're obligated to buy US government debt with it, because they can't buy stocks because the price fluctuates. They can't buy commodities because the price fluctuates. So, okay, fair enough. They buy US treasuries. If you make that hard by reverse engineering, you don't sell to America. Now, the company who's exporting to them won't see that directly. They don't get a phone call from the central bank. But the way balance sheets work internationally, the current account and the capital account mirror each other most of the time in economic jargon. So if you cut off the ability for capital to go into America to buy treasuries, you cut off the outflow of cash to the exporters, which then goes back into America. Okay, so there are various different mechanisms that you can use. And what Trump wants to achieve And if not just him simplistically, because he's a businessman, you want to sell more than you buy, but the people around him who have a very rounded view of this, they genuinely understand how it works in multiple dimensions. As you narrow that deficit, it can have very powerful positive effects, or it can have very powerful negative effects. You can have a scenario where that comes alongside high inflation and unemployment, sure. But you can also have a scenario where it comes alongside much higher investment, low unemployment, and low inflation. It depends how you structure other policies in an integrated fashion. And that will be subsidies, that will be free trade with other parties and shifting and diverting trade. That will be fiscal policy in various different forms. As I said, there will be capital controls or capital measures, which we've discussed in previous chats. And it will be everything from education to infrastructure to energy policy to housing policy to transport policy, all of them joined up together as part of this what is GDP for mechanism. And it's not as difficult as you think, because many, many countries have done it very well. And there's a certain country that starts with an A and ends with an A that used to do it brilliantly, and that was America. You were fantastic at doing this up until World War II.
Well, are we going to make America fantastic again at this? Who knows? We'll see soon. Let me ask you this, because this is a question I've been asking recently, and you kind of just gave a good answer related to it, which is, a lot of the policies and programs that Trump has announced are quite disruptive, right? And we're switching playbooks, basically, as you've been saying here. And the question I've been asking is let's assume for a second he's successful, right? So it's a couple of years down the road and he has achieved what he's wanted to achieve. Can we get to that state without near-term pain in the economy from all the transition, from the changes that might be going on in industry, from the threat of tariffs, or maybe even the implementation of tariffs before they get pulled away after the other party capitulates. Obviously, there's deportation of illegals thrown into the mix. There's a bunch of other things going on. I've just heard you say, hey, there's a path that could be really painful, to get there. There are things we could do to make the path less painful. So it sort of seems like the answer is it depends. And if it is, it depends. I'm just curious. I'm not going to hold you to it, but what does your gut tell you? Are we going to be able to get to where we are right now to where Trump wants to be in 4 years at the end of his term, without having to make some sort of, shoulder some sort of shared national sacrifice in the interim? And the main reason why I ask this question, not only because it has implications for people's investments and maybe even their livelihoods, but is if it is going to require that shouldering of shared sacrifice, that ask has not been made of the American people. Right now, all the American people have heard is, elect me, I'm going to give you a beautiful economy, right? So their expectations are, it's been a rough 4 years, it's going to start getting better tomorrow. Do you think that's likely, or do you think we're more likely to have to take some medicine along the way before things are humming along?
Great question. Let me give a longer answer and a shorter one. I'll start with the shorter one so that everyone can just memorize that and forget the long part, which is, I like America's odds. That's a purely gut level reaction, but from people I've been speaking to just in the past couple of days, who have been speaking to high-powered people in a lot of different corporates, the optimism there is quite remarkable. The change in the overall assessment is quite remarkable. That they really feel, for the first time, hey, no, we can do this. Actually, we can do this. Now, the first Trump administration got some things right and a lot of things wrong. The Biden administration got some things right and a lot of things wrong. But the things they got right in both cases were good, and the things they got wrong were bad. But the feeling is now, actually, no, there's a lot more right here than wrong, potentially. So that's the good news, that I think America has a better chance than many might think of making this work, even if that's no guarantee. Now, the longer answer is this, and I've been trying to push this thought process internally and externally, shall we say. And it's hard, because when you do a job like this, and I don't mean a global strategy role, I mean, you're one of these talking heads on TV, or one of these economic wonks, with your keyboard trying to tell you what's going to happen. They have a very limited toolkit mentally in terms of how you can try and model it and map it, which is one of the reasons why you get such simplistic answers all the time. Because if if all you've got is a hammer, everything looks like a nail.
Right.
Let's say that the main players in this, and this is again a simplification: China, Europe, the USA. That's most of the global economy. There are more, but let's put that in. Well, you've got a 3x3x3 decision matrix, pretty much, in terms of like good, so, and bad for each of them and how they interact. So you've got 27 different scenarios there. They're not equally probability weighted, and they don't account for the fact that when push comes to shove, you would rather be the country that is running a trade deficit, that is trying to push towards a lower deficit or a smaller deficit, because that creates jobs, than the one that's running a trade surplus, where people are going to push back against you and stop buying from you when you are already producing more than you can consume at home. And history shows that to be the case, that if you integrate your policy correctly, you stand a decent chance. And let me add just one more thing. When you said pain, I agree. No one's offering pain on the plate to the States right now. And
right.
I hope no one gets pain in the States. If there is no pain in the States, there will be pain elsewhere. Let's make that abundantly clear. This is not the previous world economy where, say, for example, if America had a boom, everyone else would benefit. No. In the same way, and this is a literal example, I cannot tell you, Adam, how many times I ground my teeth professionally over the years when people at institutions that ostensibly we listen to, which we shouldn't, like the IMF or the World Bank, they will come out and say, for example, China is going to grow 5% next year, hypothetically. They are going to contribute X percentage points to GDP growth. They're a driver of world GDP growth. You must have heard this, right? Many, many times.
Sure.
Well, not if China's running a trade surplus with the rest of the world. If China is running a net trade surplus with the rest of the world, mathematically, China's growth is good for China. Mathematically, China's growth does add to world growth in that China is inside the world.
Right.
But it is sucking growth out of the rest of the world by running a trade surplus. That's a mathematical fact.
Yep.
If other countries were selling more to China, then actually it would be a net add, but it isn't. Now, I'm not trying to pick on China. I'm just using it as an example that one country can benefit without other countries on aggregate benefiting. Individual countries will do okay. Like Australia selling iron ore, they can do okay in that scenario, but most don't. Most don't. They just end up buying more from China, which is a net drag on GDP. That's the way it's calculated mathematically. Okay, so America can do very well, potentially, under this kind of scenario, if it's managed right. There will be losers in equal measure in other locations, which is why you're getting some of the wailing and the gnashing of teeth and pulling of hair.
Got it. All right. Let the Game of Thrones commence. All right. So as I asked in the intro, people watching this video are investors, and most of them are regular people, retail investors. I think if I had to guess, they're maybe a little unnerved, by this transition from Star Trek to Star Wars / Game of Thrones. And they don't want to become collateral damage to it. I'm sure this transition is going to open up all sorts of risks, but also lots of opportunities. So as we enter this era, are there strategies, markets, asset classes that you think will either perform particularly well or particularly poorly, in this world?
Yes. And it's very, very variable. One of them has been very abundantly clear from day one, logically, with this thought framework, and it's already playing out. So when I say it now, in the short term, I don't know how much more juice there is left in that, but it can certainly, in theory, go much higher if it continues, which is the dollar.
I'm pretty sure I know what you're going to say, which is
the dollar.
Gold. Oh, the dollar.
No, the US dollar. I'm starting with the dollar, because the dollar absolutely can be a winner in that scenario, and has been, because as you narrow your trade deficit, there are fewer dollars flowing to the rest of the world.
Mm-hmm.
And Americans may not be aware of the fact that there is a mind-bogglingly large amount of dollar-denominated debt outside the US,
Right. The
called the
euro dollar
Eurodollar.
market. Yeah.
Yeah. And if there's less flow of liquidity into that, at the same time that American interest rates are high, which they still are and may remain there, we don't know, which makes it servicing dollar debt expensive, there is going to be a mad rush to try and get dollars in the euro dollar market, which will crush other currencies. And you're already seeing some emerging markets, at record lows. They can be at much more recorder lows. And when you look at dollar yen, for example, that swung from 140 to nearly 155 in a couple of months.
Mm-hmm.
You show me one FX forecaster brave enough to predict that dollar yen moves from 140 to 155 in like 2-3 months. And, I'll buy you a drink, because they don't do it. But that's the world we now live in. And it can be more extreme than that. And I don't just mean dollar yen. I mean lots of crosses. Now, of course, it can swing back the other way briefly too. You can have big moves back the other way. But the overall trend, I think, is dollar friendly. Now, in terms of gold, just to bring that up, as you know, in previous years, I've never been a particular fan of gold because it doesn't, pay a dividend. Paper gold, if you're going to go the whole route, why bother? Have physical gold, and that's expensive and heavy and can be stolen, etc. And the past track record in the kind of low inflation, high debt world we were in prior to, the post-COVID and more geopolitical world that we're in now, that was an environment in which you would say, well, look what happened in the 1930s with gold. The Fed just made it illegal. So you thought you had a hedge against currency depreciation and money printing. And they just said, please hand over all your gold tomorrow. And if we see you using it, you go to jail. So you don't have that hedge. Gold, of course, has now done very well up until the last week or two. Because internationally, as the global order starts to fragment, and particularly as sanctions start to be used as economic statecraft, which they are, we're targeting you. Holding gold as a proxy for the dollar, and I stress as a proxy for the dollar, is not such a bad idea. You can always sell a bar of gold as a central bank somewhere for dollars.
Right.
Or you can
And
trade
that's
it for
exactly
dollar
why
value.
I thought you were going to start with gold, which is as the players start to trust less the other players on the chessboard and trust their currencies less, because I don't know what they're going to do with their currency against me. What's the one currency substitute that I can trust? And we've been seeing central banks ramping up their gold purchases. So, okay, that's exactly where I thought you were going to go.
That is true. I don't know how much further that will go if you're in a world in which Trump moves as aggressively on this as one would think. Because first of all, the dollar will go much higher mathematically. Secondly, those central bank reserves are not going to be going up because those central bank reserves are a product of selling to America.
Right.
So the net increase won't go up so much. And thirdly, Trump is very much going to be Team America World Police with the dollar. I'm not going to sing the song because it's not safe for work, right? But that's going to be being hummed alongside the dollar. Now, you have an adjunct to that. Again, in previous chats, you've asked me what I think of crypto, and I've told you crapto, because I couldn't understand why anyone would allow everyone to print their own money at home when it's illegal to do it with any other currency. Clearly, that's no longer the case. When you have, Trump coming out pre-election and saying, I want crypto to be made in America, not made in China. I don't know what the hell he means by that, but clearly there is going to be some kind of role for crypto. It's not going to be a currency. It doesn't work as a currency. No one will ever spend it. You hoard it, which means it doesn't work. But as an asset, if for whatever reason, and again, I scratch my head to understand why, other than it's a new bubble that can be blown to get people feeling richer, to provide some nice painkillers while you go through this economic transition, which is not to be sniffed at. If you're going to have cheaper housing relative to salaries, which is certainly something America needs, so you can't speculate on housing. And if the stock market gets to a point at some point soon where, okay, it can't go higher than this, surely, and people say, right, so stocks can't go up anymore, but you need to have some kind of go-go juice in the economy somehow while you're making this transition. Who knows? And I'm completely spitballing here, but maybe some kind of crypto boom is going to be something else to keep people tided over for a few years. Again, completely making it up as I go along on that front. Maybe that's why he wants to use it, because I can't think of any other strategic use for it. Well, then, okay, fair enough. Then, crypto is an adjunct, and maybe more than gold to that degree. Although, again, what goes up can come down. But above and beyond that, remember, if the dollar goes up, commodities come down. That's mathematical, that link. And Trump, again, is very, very clear that he wants lower energy. And energy is already in a bear market anyway. So if you've therefore got that happening with Trump saying drill, baby, drill, that is deflationary, but obviously not so good for those commodities. But then you consider Trump's a friend of the American farmer, or wants to be, and they need to make sure that the crop prices are held up. So then you start getting back to economic statecraft, which is, where are we going to find a buyer who's prepared to pay a nice price to buy from America rather than buying from Brazil or someone cheaper? And you start getting into trade deals where, for example, you say, we don't put a tariff on you if you're going to buy all my corn to prop up demand, for example. Yep. So you can't generically say all commodities go down. The ones that economic statecraft within America says need to go up may well go up. And sectorally, again, I don't give, trading advice, and to make that completely clear, but other people have already been flagging, here are the sectors Trump would like and wouldn't like. They perform, meh, it depends, because it's very hard to guess exactly what's needed. But this is where, to go back to the report, don't try and just think what Trump is saying today, because that's already something that should be in the money, right? Should be in the price.
Should be priced in.
It'll be already priced in. Have a look and think strategically, what would need to do well as a cog within a mechanism to make GDP look like the way it needs to look like. If I understand what GDP is for, what is going to be needed for that? And try and look for those. That would probably be.
Can you give us one example of a cog that you feel like is pretty good potential to get fed here?
Well, the problem is when you say, okay, like energy, clearly, but energy prices are going to go down. So that's not good for the firms involved. But then equally, you don't want to destroy their share price. So I don't know if there's going to have to be subsidies thrown in there or something to try and encourage them to do.
How about everyone's favorite villain, the military-industrial complex? I mean, if it's all about protecting power, do we expect Trump to feed that even more?
Well, yes and no, but okay, here's a curveball for you. On one level, completely, and thank you for the suggestion. On the other, I think it's an open secret within the US that there's an enormous amount of price gouging that goes on at these companies.
Yeah,
I'm sure that you could reel off as many examples as I can of $150 widgets and
right. And we now have Elon and Vivek going after, with the
exactly. So in this respect, when we were talking about winners and losers, it could well be that the macro picture in the US improves. So the relative purchasing power of consumers is better going forwards in a multiple of ways, but particularly at the lower income echelons. But that your punt on a financial asset like, defense company A or B or C, I won't name names, actually doesn't pan out, because even though there are more orders coming in, the profit margin is much lower, and they're going to insist they can't gouge them. And logically, by the way, if you look at how the US manages its procurements, that's a no-brainer. So this is, again, thinking beyond the obvious trade of like Trump likes defense, therefore buy defense stocks. No, think what's good for the USA Inc. in the long run. And that, to me, and again, I'm thinking out loud here, suggests it's still probably going to be more consumer staples. But again, consumer staples from companies that can benefit more from more local production. The ones that aren't entirely reliant on a supply chain and logistics network where all their profit margin comes from producing very, very cheaply further away. Who are the people who are already better placed to deal with an economy that's going to be more localized? And by the way, logistics would be one too. There are lots of logistics companies that are going to have a lot of work on their hands if this onshoring is going to happen.
All right. Fascinating. All right. Well, look, Michael, we're at the hour here, so we're going to have to wrap up. Thank you so much. Fascinating topic. I love the way you see the world. And I do want to give you full kudos that we've had variations of this discussion over years, and the world has only become more and more the way that you have predicted. So congratulations, and would love to you to keep coming back on this channel as often as you like to keep us tracking reality as it continues to unfold here. For
Can I,
folks that
can
have
I just,
really, yeah,
Adam, sorry, can I just chip in one thing? I got a joke I have to make, if I
absolutely.
may. Well, it is quite ironic, and we're not all the way there yet. If we had a US Commerce Secretary or US Trade Representative called Robert Lightsaber rather than Robert Lighthizer, then I would be dropping the microphone. But we're not all the way there. We're half the way there.
We're so close. We're so close. Okay, yeah. Until we get Department Head Skywalker, you can wait to take that victory lap. Okay. Well, look, for folks that this has been very eye-opening for, and they would like to continue to follow the arc of this story in between your appearances on this channel, where should they go?
I would say the easiest way for people who aren't a Rabobank client, which I presume is the majority of viewers here, is to follow me at my X handle, which is at the Michael Every. And there'll be snippets and discussions based around my work there, and obviously more thoughtful channels like this one where we can have more long form discussions.
All right, fantastic. Well, look, as a subscriber to your X, I highly recommend everybody go follow Michael over there on X. Michael, when I edit this, I'll put up your handle on the screen so folks know exactly where to go. Folks, I'll have the link in the description below the video too. All right, Michael, any parting bits of counsel for the people watching this video who just got rollicked by the truth bomb that you dropped on them about how the future is going to unfold here?
Yeah, I think you're better placed than you think, because dealing with the industry for nearly, the better part of 3 decades now, and I think you will concur, Adam, from your side, there is so much entrenched thinking that can't cope with the changes that are happening, or only have rigid tools that mean they simply can't compute the implied changes that are happening. Even if you're just a, Joe Sixpack, Joe Public, which I am too, you are ahead of the curve in not being weighed down by this policy baggage or this methodology baggage. Common sense, and a lot of what I'm describing is just common sense rather than highfalutin logic or theory. It's really basic stuff, can actually put you well ahead of quote unquote experts. And we've seen that time and again in different fields over recent years. And so don't feel intimidated by it. Don't think just because you're sitting there at home worried about what the world looks like, that there's someone sitting on the 40th floor of a skyscraper who's got a far better view of all this and is going to be reaping the benefits. No, they were reaping the benefits of a system that was set up previously in which you were definitely behind the curve. We're on a level playing field here, and in fact, if anything, I think the higher they are up in those ivory towers, the less clear their view is of things. So take that as encouragement.
All right. Oh, it's very nice to end on a positive note. All right, Michael, again, I can't tell you much how I enjoyed this discussion. Thank you so much for joining us half a world away here early in the morning your time. Really look forward to having you back on the program again soon.
My pleasure.
All right. Well, now's the time on the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. We'll react to what Michael had to say, but a lot has happened since you guys were on the channel. I'm joined with, as usual, by John Lodra and Mike Preston, two lead partners there at New Harbor. Gentlemen, thanks for joining me. Like I said, lots happened since you were last on. John, why don't we start with you? I think this is your first time on the channel since we know who won the election. I don't want to sort of rehash Michael's whole framework here, but he's certainly, given us his framework for how he sees life under a more mercantilist future, both in the US and in other countries, but certainly Trump's policies seem to be a lot more mercantile than Joe Biden's. What are some of the key things you guys are looking at New Harbor in terms of what markets under a Trump presidency would look like?
Yeah, Adam, a lot's happened, certainly the election being chief among them. And certainly there have been some short-term reactions to the election, some of which that you might say were very predictable, given some of the telegraphing of policies and things like that. Michael talked about some big takeaways that certainly resonate with what the markets have been doing. Key areas of reaction in recent weeks and certainly accelerated in the wake of the election. U.S. dollar strength has been on fire. The U.S. dollar has been on a tear here for many, many days leading up to and following the election. You can say that the markets were probably the only thing that was predictably accurate in kind of calling the election outcome. The markets seem to, whether you're talking about the betting markets or the financial markets, they were completely ahead of the polls in predicting what ultimately happened in the election. So we saw the dollar strengthen tremendously. We've seen yields on bonds sell off or rise, and longer terms bonds sell off. These are all very much in the consistency with the kind of picture that Michael Every spoke about in terms of protectionism, mercantilism, and kind of every country for themselves. And certainly Trump and his team of advisors have been very vocal about the idea of tariffs, whether they're for real or just a bargaining tactic. We'll see. But also kind of things that speak to some of the trends that Michael talked about. I thought it would be fun to just take a quick look. Now, I'm going to first disclaim this chart that we don't think this has really any meaning in terms of the long term, but it's fun to look at kind of the reaction to the markets in the week following the election this year versus Trump's last election in 2016. And you see some common threads here. You see things like financials and energy rallying, industrials, kind of the pro-cyclical type of things, domestic growth kind of things. And you see things that are rate sensitive start to sell off, things like real estate, long-term bonds. Dollar strength is another thing here. Things like commodity and gold have sold off in the week following both this year's election in 2016. And that's just very short term. Frankly, I think the big takeaway here is that there are going to be short-term moves that are probably kind of thematic in nature with what's happened in the election and the policies that will come. But we have to reorient to the bigger picture of valuations. And there was an article in Bloomberg the other day that spoke to this. And here's a chart of the cyclically adjusted PE ratio. And it basically goes back. We're at near record highs, and in fact, if you look at some augmentations to this metric, we're at valuations that we've never seen before, even eclipsing the 2000. But the case here made in the Bloomberg piece was that expensive markets can, I use Trump in air quotes here, but valuations can trump any number of otherwise productive and sound economic policies. Simply, the market has gotten too expensive. We actually think, and Michael covered this, I think, in a bit. We actually think the market probably has some very strong momentum into year end, but we think we're very late stages of a very overvalued market, and we're positioning as such. And we can kind of get into our constructive positioning, but also some of the hedges that we have in place in just a moment.
All right. So this has obviously been a theme that's been on this channel a fair amount, and of course, you guys have been beating the drum about valuations for a long time. As folks like to remind us, evaluations aren't a great timing tool, but they do give you a sense of the likelihood of a reversion, right? And the higher these valuations go, the more likely a reversion becomes. It's one of the reasons why I really like the approach that you guys follow at New Harbor, which is even though you may be still in the market because you expect some continued momentum from here, you are cognizant of the fact that the reversion risk is increasing, and therefore your policy of using hedges basically to purchase some insurance, some downside insurance, should indeed, while you're still long, the markets start reverting, you've got some good protection against that. John, you're nodding as I'm saying this.
Yeah, it's exactly right, Adam. It's the closest we know to having it both ways, and there is no free lunch, of course, but it's a way to be postured in a productive way, but have that tail risk hedge in place that, frankly, at the end of the day, we hear from our clients, and we think rightly so. They're concerned. Their retirements here are money they don't get to do over on. And, the similarities between where we were last couple of bubbles are very, very, very fresh in their memory. And they want this money to last their lifetimes, not just the next year.
Yeah, and we've used this analogy a lot in the past, but if you're going long, especially fairly aggressively long in a market that is at stretched valuation extremes, you increasingly run the risk of picking up nickels in front of the steamroller, right? Is it really worth it to stretch for the remaining upside that may be there, given the growing potential of a potential material correction? So, anyways, that's what financial advisors like you have to grapple with, and it's why I like having you guys on this program every week. sharing with folks where you are on trading off the risk reward, how much are you in versus how much are you playing defense. So Mike, let's shift over to you. As I said a few minutes ago, a lot has happened since you guys were on the program just 2 weeks ago, right? Obviously, we've got a new president-elect, but S&P has broken through 6,000, which is something that Mike, you and John have been saying for a good while. You wouldn't be surprised to see markets run up into the end of the year. I think Mike, in your case, you're almost sort of looking for like a blow-off top. Curious if you think you're seeing that type of action now. As John mentioned, gold, which I know is a big position of yours, has taken it on the chin a bit since the election. And Bitcoin, which is an asset that you guys have relatively recently added to your portfolio, has gone ballistic. And I don't know where it is right now, but as of a day or two ago, it had risen to over $90,000 a coin, where just, I don't know, a month or two ago, it was down in the 50,000 range. So Mike, which of those do you want to start with first?
Hey, Adam, thanks. I think I'll just encapsulate a lot of the changes that we saw over the last week or so since we talked to you last, or since the election at least. And there's been a lot of changes. And so I'll do my best to summarize that and share a few charts that hopefully will encapsulate and communicate what we're looking at here. So we'll start with the S&P. All right, so here's the S&P 500 on a daily chart. So right here, you can see this big gap. This S&P 500 has been in an uptrend all year. It's been a really strong market. As you said, we've been sensing, and the indicators that we look at show that we're basically expecting and seeing a compressed move upward, a so-called blow-off top, if you will. And some of the short-term sentiment indicators are definitely swinging from pessimistic to strongly optimistic, and maybe even and a cautionary tale, moving up rather rapidly after the election. But these things are not good timing indicators. These over bullish indicators could easily suggest that we see a top 2 months from now versus now, for instance. So be careful trying to time a top with sentiment indicators. They're often slow moving. But here's the S&P 500. We had this big move higher. Let's take a look back at the monthly chart. I think it illustrates it even better. Just what we've been living through here this year. So this market has been up basically every single month. There's been 1 month that was down early in the year. This a few months ago, I think was August, after the Japanese yen surprise. The market sold off and then recovered very quickly. And here we are in the month of November with another big up bar. What you'd expect to see in a blow-off parabolic top is something like this. You've got a market all year that just won't correct, and then maybe you see a couple months of really compressed action. So here we are at 6,000. We're definitely getting there. Maybe we're there. We're not willing to bet that we're not there, but if we get another month or two, straight up 6,250, 6,500, I think that will be basically ringing the bell. Going back to, go ahead.
Sorry, just go back to that chart for 1 sec there, Mike.
Monthly, sure.
I just want to point out the similarity between the crazy run that we've seen, pretty much, I guess, all year, but you could trace this back to really the beginning of 2023, where almost every month has been an up month and your down months have been short-lived. Not that dissimilar from the 2020 bottom up to the start of 2022, right? And as John showed earlier, looking at things like, the CAPE ratio, we're now at a valuation height that is now higher than it was at the beginning of 2022. So we're seeing a lot of history rhyming here, we'll say.
Yeah, absolutely. We're seeing a lot of history rhyming. And so you start to see, compressed moves in a short period of time here. And so if that keeps happening, it's going to be even more of an all clear signal. Now, so what you're talking about here is the run up to early 22 led to a drop in 22 like this, but that was actually relatively contained, a 20% plus drop that of course just launched us onto what we think is the final blow off top. So no guarantees, but this is what you'd expect to see, along with record high valuations that just persist. This is not the new normal. It's not we don't think, a permanently high plateau. And so we're looking for signals that tell us to tighten hedges and or get out, even into a lower equity allocation. The real difficult thing is going to be to try to not give back much or not lose on the turn. That's going to be really, really hard. And now I'd just like to share a couple point and figure charts. These are different charts that compress time. Here, this chart is of Bitcoin. I'd like to talk about that because you asked about Bitcoin. The reason it compresses time is because the column of X's and O's don't change until there's some meaningful move in the opposite direction, in this case, 3 boxes. But Bitcoin, and let me just mention one thing about Bitcoin. Bitcoin is extremely speculative. It's not tied really to anything intrinsic. As Michael said, it's a store of value, not a currency. It's become clear it sounds like to him and to us that it's here to stay, and the blockchain is here to stay. And it is a store of value, but it's become very recognized on Wall Street. And there's been a number of ETFs that have been introduced in the last year. The SEC approved these ETFs. However, very speculative, and it's not for everybody. And so certainly this is not a recommendation. Talk to your advisor about it. But we did add a position in Bitcoin. It's a very small position. It's 1% of our portfolio. And I guess I'd say also that it's had a very big run since we put it on a few weeks ago. It's up about 35%. And so a pullback could happen at any time. But take a look at Bitcoin here. It's a big, really inverse head and shoulders pattern on the bar chart too. And then there was this downtrend line here basically all year. We popped out of that here last month, a few weeks ago, and we added it because of that breakout. That's it, because we think it's the chart is basically stable and has proven itself, and it broke out and we added a 1% position. So it's difficult to enter here. It's up on a stem. Again, look for a pullback. We'll probably at some point trim the position if we continue to move higher, but Bitcoin has proven itself here, and the chart looks like one of the best that we take a look at. A really quick look at gold and silver, and then I'll take a pause. Here's the gold futures continuous on a daily chart here. No, not sorry, a daily chart on a default chart. And take a look here. There's been a really big pullback. We touched 27.90. We're all the way back down to 25.80. However, if you take a look at this, and if I move this out to a slightly longer scale, you'll see that this consolidation over the last 4 years that we've talked about so many times here, and then the breakout down at 2000, it went right up to 2800. Really nothing is broken on this chart. A really short-term trader may say, well, there's a double bottom break there. But honestly, this uptrend is very intact. And I would say it would have to go all the way down to 2300 for us to be really concerned. Now, I understand that's a long way down for some people that are maybe more short-term in nature, but the gold chart is still intact, and we do expect higher prices, probably in the next year, 3,000 to 3,500. Lastly, on silver, just to prove why silver is so hard to hold on to. Silver too has had this long 3-4 year consolidation and a breakout to about $35 an ounce. It's all the way back to $30 an ounce, but really wouldn't break down until 26 to 27. We think that silver will consolidate and break out higher and hit the high 30s, maybe even 40 in the next move higher. So really hard to hold on to, because this is a 15% pullback or even a little bit more. And some of the miners have pulled back even more than that, 20 to 30%. So hard to hold on to, but these assets are still, we think, good long-term holds. And lastly, and maybe John could talk a little bit more about this, we have made some changes to our portfolio in addition to adding a little bit of Bitcoin. We have increased our hedges on the S&P from 5,400 to 5,600 on this strength. We continue to move up that floor, so to speak. Then we added a little bit of equity exposure here. We added about 2 or 3% equity exposure, but still very, very conservative, somewhere around 42% or so, in the low 40s.
All right. Thanks, Mike. All right. Well, John, look, I'll hand the baton back to you. I'll let you bat cleanup here. We're at the end of our time. Any bit of parting bits of advice for the viewers here?
Yeah, Adam, I just want to kind of just emphasize the hedging that we've done, because it does have a real impact. So let me share a chart of the gold mining just as an example. So this is a chart of GDX as a proxy for the gold mining space. we have hedges in place that dramatically scale back our position. First of all, we did take profits and scale back our position right around the 41 area, right around here.
Right. I'm just to interrupt. I remember you saying that here on this program that, look, we think things have been great. We're doing our rebalancing, which every prudent investor should do, especially when a position makes a big run. And here's validation of why you do that.
Yep. So we took some profits and scaled back our position to a model weight right around here. It pulled back and then rose higher. We've had a dramatic sell-off here, and I'll show you a chart of the dollar in a second to explain that. But we have put options right here that essentially took half the position off the table. So our model position, even though it's 10%, essentially right here, and this move down here, it's like as if we only had a 5% position. So much of this sell-off here has been offset by the put options. Now we're at an important proving ground. We broke through the 200-day, which is that's the blue line here, and we're kind of hugging this 50-day lower Bollinger Band, which is a 2 standard deviation measure below this 50-day. These are technical terms. So it's a very decent chance we get a bounce here. But the point is if we do continue to trend lower, our exposure is rather contained because of these put options. Let's just show you what the dollar chart has looked like, because it really speaks again to what Michael talked about in terms of dollar strength. This is a daily chart of the dollar. We've been on a rocket ship here. This is the dollar index, DXY. Was right around 100 back at the end of September. We've shot like a rocket ship here almost without hesitation. This little pullback here was when the S&P was pulling back a little bit a couple weeks ago, when the election polls were seemingly to cast in doubt how well Trump would do. But that's been a rocket ship ever since. We have a turnaround so far today. So this may be a sign that we're getting a little extended on the dollar in the short term, and we may see a likely pullback or snapback to the upside in things like gold, in things like commodities that have sold off with a strong dollar. But speaking to some of the tactical changes we have made, we did sell some weak sectors like the consumer staples, and we actually took profit, sold in other sectors, software, for example, which was a massive spike higher. We took profits, sold into that strength, and added broadly to our mid-cap exposure. We like the mid-cap space. There's a lot of fundamental reasons why that should do well in a kind of policy environment that Trump's administration seems to be touting. And we prefer to focus on the mid cap, because unlike the Russell 2000, which has a pretty large component of smaller companies that have negative cash flows, just aren't profitable, the core mid cap is much less affected by that. So all else being equal, more solid companies, but playing catch up to, we think, the larger cap companies, which have ruled the day for much of the last several years.
All right. Look, thank you guys so much again for being so transparent with the decisions that you're making, given the unfolding realities on the ground here. Again, I think it's really valuable that people understand the role that hedging plays in your portfolio, because you're showing here, over this past most recent activity, how that hedging really can come in to save your bacon when a position that you have starts reversing. All right, gentlemen. Well, look, thanks so much. I just want to quickly wrap up here. Folks, if you enjoyed having Michael Every on this program and would like him to come back on the next time he has any major change to his outlook to share with us, please let him know that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And if you'd like some help in positioning your portfolio for the type of future that Michael sees coming, or for some of the macro and market issues that John and Mike have talked about here, highly recommend you do that under the guidance of a good professional financial advisor who understands all the things that we've talked about in this interview. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you'd like a second opinion from one who does, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me every week on this program. Perhaps you might even want to talk to John and Mike and the team there at New Harbor. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. These consultations are totally free. There's no commitment to work with these guys. It's just a free public service they offer to try to help as many people as possible position as prudently as possible for what may lie ahead. John and Mike, gentlemen, thank you so much. Good recap of a lot of changes in this very short time I gave you today. Really look forward to catching up with you next week and seeing what you think the next evolution of what's happening in the markets tells us.
Thank you, Adam. We look forward to next week. Have a great day.
We appreciate it, Adam. Thank you. See you soon.
See you guys. Everybody else, thanks so much for watching.